Well, next Tuesday night we'll see the Australian federal budget, and there'll be a lot of people that'll be watching it very closely, and in particular after the news of this week, the Reserve Bank and Philip Lowe will be very, very interested watchers. The Treasurer is in a very interesting situation. We estimate that his bottom line relative to where he thought he was going to be in October last year has improved by $110 billion. Now that'll have to be offset by the increase in some programs, for instance aged care, where there's going to be a substantial lift in wages for aged care workers, costing about $30 billion. But the net point is that there's a lot of money available for the Treasurer to disperse. So why is the budget in such good condition? Well, I think the main reason was back in October they assumed that the iron ore price would fall to $55 by March 2023. Well, it's actually still at $120. They'll have to change that assessment, of course. We think that they'll push that $55 out to the end of 2024. Along with stronger inflation in the economy and a stronger labour market, that will provide that $110 billion improvement, and it'll include almost a surplus for 2022-23. Deficit in October was estimated as $37 billion. We estimate it'll come down to a deficit of only $7 billion and could even be better. So where do we think this money will be dispersed in the budget? Well, the economy is not in great shape, and in particular the household sector is under great stress with high inflation, high interest rates. So there'll be relief for parts of the household sector, particularly around rental relief, energy relief. We think that JobSeeker will be raised for people over 55, and we'll also see assistance generally on housing. Health costs will be reduced, our medicine costs will be reduced, and we'll see energy relief for small business in terms of encouraging to go green. I'm sure there'll be many other aspects of the budget that we'll find out on Tuesday night. On the tax front, multinationals will come under the microscope. We'll see rising taxes, we believe, for gas companies. I don't think they'll touch the stage 3 tax cuts, but that still remains a moot point. I think if they were to touch them, it would really only be to lower the threshold from 200,000 down to 180,000. So what do we think is a reasonable amount of spending in terms of what may avoid putting upward pressure on inflation and interest rates? If we look back through the last 10 years, the new spending for budgets in the first year was generally about 0.25% of GDP. That's about $6.5 to $7 billion. Over the 3 years, about 0.5% of GDP, about 13 or 14 billion. So we'll be watching it through that lens. If the new spending initiatives are much, much greater than that, then we'll be starting to get nervous about the impact on inflation and interest rates. But we are expecting to see a fair degree of discipline in this budget. Thank you.